To introduce myself, I'm Peter Sofer, a venture capitalist and creator of the Art of Pseudo Exit Windfall calculator, which I'm presenting here. The purpose of this tool is to determine how a startup's exit value is divided among the company's stakeholders. And what's powerful about the tool is that it enables entrepreneurs and investors alike to project returns they will see under different financing and exit scenarios. And likely more relatable, it enables the rest of us to speculate how rich the people behind startup successes must be. To begin, we fill in the key inputs for this model, which are highlighted in the orange cells in this key inputs tab. Most of these inputs focus on the shares the startup team and various investors own of the company. And this, in this first set of inputs, we focus on exit amount and timing. So this fictional company, Magical Wonders, in this model, in this iteration of the model, it's exiting for $18 billion on January 13th, 2023. And the shares that the common stock, the shares that the team owns of common stock, we see that the founders, we see that there are two co-founders for Magical Wonders, each of whom own 35% of the common stock. And then the early employees, the earliest employees get about 2 cents. The 10th employee gets about 1%. And these are just sort of custom inputs that I just use based on what I've seen in my experience, but this is very company specific. So if you know if you're doing this for your company and you know that you know these numbers, then you can customize them yourself in this model. And we're assuming a tax rate of 35%, which is around the ballpark of what's standard, give or take. And then we assume a total, and this is just for the back end calculations, but we assume a total of 10 million common shares to begin the company pre-investors. Next, we enter values related to the company's Series Seed equity financing and pre-Series Seed notes. So these are the first investor allocations or contributions or financings into the company. The earliest financing in Magical Wonders here is a March 2013 pre-seed convertible note. What we see is that the cap of this note is 5 million. The principal invested in this note is 1 million. There's a discount rate of 20% and a interest rate of 8%. And these notes convert at the Series Seed equity financing 6 months later on September 1st, 2013. The pre-money valuation is $8 million for this round. The share price is almost 73 cents. The amount allocated is 2.8 billion to 2.8 million to Magical Wonders. Liquidation preference is 1x. There are some options added pre-money, and all in all, including the note conversions and the Series Seed financing, the post-money fully diluted valuation after the Series Seed round was about $12.5 million in Magical Wonders. Next, then for all applicable future financings from Series A through Series E, we enter similar inputs. And here you see me scrolling through. This model has the power to go through Series E. What we see with Magical Wonders is that they had a fairly sizable Series A financing of $12.5 million after this pre-Series A notes round as well. But they were able to get a pre-money valuation of $25 million on this round, which is pretty good. And I could scroll down, but we next move to the dashboard, which is where these inputs, the first part of the dashboard is summarizing these inputs. So $18 billion exit value for Magical Wonders. And then we see the terms for Series seed financing, the pre-money and post-money valuations for then, and similarly for Series A, for Series B, notes and equity, Series C, Series D, and Series E. So you see Series E is the last round of financing for Magical Wonders. It occurs January 1st, 2021. The principal amount invested is 400 million, and this is really growth stage. Most companies don't reach this. Most companies want to sell themselves before they even get to this, because it's actually quite risky not to sell yourself before this. But this is where the real big bucks are made if you get there. The pre-money valuation was $4 billion here, and the post-money was 4.4 billion. And what we see is that in all, there's about a little over $1 billion invested in Magical Wonders before they exit cumulatively in just principal. And then if you if you factor in the interest rates on liquidation preference, the total liquidation preference of this of all the financings are about 1.3 billion. Next, we learn what proportion of the company each shareholder class owns after each financing round. So what we see is after the Series E financing round, the common stock, so the team plus advisors, they own, and just the options that were allocated as part of each round. The common stock owns around a little less than 25% of the company after Series E. If they had not done the Series E and just had done the Series D, the common stock would have owned about 26.3% of the company. If they had not done either Series D or Series E, post Series C, the common stock owned almost 30% of the company. Post Series B, they owned a little over 34%. Post Series A, they owned a little over 40%. Post seed, it was around 64%, and 100% if they hadn't taken any investment at all. And so what percentage of the distributions do the various stakeholders see? So focusing on the Series E financing, what you'll see is that the percentages for the exit distributions are the same as the fully diluted share percentages. And this is the case because an $18 billion exit is extremely good, and it dwarfs the amount of investment to such an extent that liquidation preferences don't really matter, and everybody, all stakeholders exit, or all stakeholders see and exit the proportion of stock that they own. But imagine if this were not an $18 billion exit. Imagine if this was something like a $2 billion exit, which usually is good, but if your final round assumes a $4 billion pre-money, it's pretty bad. So let's say $2 billion exit. What we see is that while common stock owns 24% of the company, they would see about 12% of the distributions in this scenario. And we'll get more into just the variance in the distributions of each of the stakeholders later on, but it really revolves around the the fact that the last money in is the first money out. So the for a weaker exit, it's the common stock and the seed, and sometimes the Series A and B that often doesn't see doesn't see uh, their their sort of ownership percentage in the distributions. And what you'll see here is that the Series E shareholders get 18% of the exit distribution instead of the not, which is almost double the 9% that they own, because before anybody else gets a distribution, the Series E shareholders see $450 million. And so with this $2.5 billion exit, the Series E shareholders get out with that liquidation preference before anybody else, and that's what juices the percentage that they see in the exit. Next, we learn the exit amounts related to that these exit distribution percentages translate into. And so, assuming a $2.5 billion exit, what you'll the Series E shareholders get their liquidation preference, which is for a little over 450 million. It's right here. As do other shareholders as well. And what you'll see is that the common shareholders get around 300 million of this 200 this $2.5 billion exit. And this is just food for thought for people who study these exits. And $2.5 billion is a huge exit. But if you raise too much money, the entrepreneurs and the team see very, very little of it, and that's often a shame. That flies in the face of the American dream to a certain extent. But it just goes to show that you have to really be smart and strategic about how you raise, and if you over raise, then you get squashed on the cap table. But going back to the 18 billion scenario, now the common shareholders see over 4 billion in this exit. So because the exit exceeded investor expectations, now the entrepreneurs do really well. And this next table really dives into how the entrepreneurs actually do. So in a post series, if they raise all the way through Series E, each entrepreneur at an 18 billion exit is pretty much a billionaire after tax. So this is post-tax allocations to the different to the various owners of common stock. So you see the co-founders, if it's an $18 billion exit, are pretty much billionaires. The third employees 3 through 10 are all set for life, and the board and advisors do really, really well. This is an incredible outcome for everybody involved. Meanwhile, if it's say this was 2 billion, the founders still do pretty well, but employees 3 through 10, they do well on the surface, but they've spent 10 years in this business, and the distribution they're seeing is less than a partner at a law firm makes in 3/4 of a year. So they're doing very well. They're doing well by pretty much all standard metrics, but it's still it's still not well enough to really cement their status in one of the higher tiers of wealth, and it's not what you'd expect um, for somebody who's the third employee for a company that exits for $2 billion. Again, circling back to the theme of you got to be strategic about how much you raise if you're an entrepreneur. Also, another theme is just the the extent to which the founders reap the benefits relative to the other employees. So next, it's more sensitivity analysis on how much each shareholder type receives based on the uh, ex based on the exit valuation and the amount of rounds of financing that the company receives. So what we see here is that in a $2 billion exit, the common stock would do very, very well. They would get over 60% of it if you only raised through Series seed financing. And the the uh, the common shareholders actually do better in a $500 million exit where they only raise through Series seed financing than they do in a $2 billion exit where they raise through Series E. Um, so that's just sort of showing the relative benefits of raising more versus standing pat. Then we see the exit distributions for the various tranches of shareholder classes if they raise through Series A for different exit valuations, if they raise through Series B for different exit valuations, Series C, Series C, Series D, and Series E. And I'm going to change this exit value back to 18 billion so that we get a feel for how that changes things relative to the $2 billion exit. And you see in pretty much every scenario, the entrepreneurs do better if the for an $18 billion exit than they would in an exit that's a fraction of that amount. But what's also interesting is that liquidation preference is really coming into play here. For some of the smaller exits, say it's a $500 million exit and the company raises through Series Seed, both the Series Seed or Series C, both the seed and the common stock, they see no exit distribution due to liquidation preferences. And that only gets worse for the lower the exit amount. As stated earlier, last money in, first money out. And the next portion of our dashboard is just drilling down on how well the common stock does in the different scenarios with a highlight on one of the co-founders and employee number 5. So in a $2 billion exit through Series C, or in an $18 billion exit, the common stock gets 24%. But in a $2 billion exit, they only see 2.3%, and they don't see anything after a Series E financing in any of the other scenarios. Just sort of the analogous value that the founders see, in this 18 billion exit scenario, a founder would become pretty much a billionaire after Series E financing. Um, and if they only had to raise a Series seed, a founder would would uh, would earn upwards of $2.6 billion on this $18 billion exit. Single founder who owns 35% of common stock. But what you see here is just employee 5. In the $18 billion scenario, they are set for life no matter what. But it's the founder dwarfs them in terms of the wealth that's accrued. But if it's a $2 billion scenario, it's much more dependent on how many rounds of financing are raised in terms of how well employee 5 does. For example, if they hadn't raised that Series E financing and they had this exit, employee 5 would have earned $4 million post-tax instead of $448,000. Now, the last part of this analysis is a Monte Carlo sensitivity, where this entire analysis hinges on very subjective inputs. It can hinge on subjective inputs if you're using this tool to project out future rounds and project out your financing distributions under different under different financing scenarios. And so we do a Monte Carlo sensitivity analysis where, for these subjective inputs on terms and ownership stakes, for each round of financing, we use the inputted value as the mean, and then random numbers are generated within a 20% standard deviation of this mean. And each time the model refreshes, these randomly generated inputs flow through the model to produce different outputs. And each new output is the result of a simulation. And this Monte Carlo analysis encompasses 1,000 simulations. And so what we see here is, in a post-series seed exit scenario, the maximum that the common shareholders own is about in the maximum simulation of the 1,000 simulations, the common shareholders own 30% of the company. In the minimum, they owned about 18.58% of the company. In the median ownership number was around 24.27% of the company. And then in terms of exit allocations, the maximum for founder 1 was for one of the founders was almost $1.4 billion post-tax, and the minimum was almost $6.23 million post-tax. And then for a post-Series E, assuming Series E financing for employee 5, the maximum was almost $59 million post-tax, and the minimum was almost $27 million post-tax. And this is all assuming the $18 billion exit. If this were $2 billion, what we'd see is 0 for 25% of simulations for common shareholders, which include the founders and the early employees, but also a max situation where the founders might still do very, very well. So with that, that's the end of the dashboard. In terms of how this model works, the back-end calculations are the engine. And here's just a scan of how they're formatted. I won't get into the weeds on these calculations, but it's it's basically just an amalgamation of different rounds of company capitalization tables stacked on top of each other, which with each round's terms baked into these cap tables. Now, thank you for your attention. I hope you've learned something about how startup exits work, and maybe even about how to structure the financing rounds of your own startup. And so, yeah, thanks for your attention, and please leave comments, uh, whether it's room for improvement or other sorts of comments.